Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been helping people take delivery of precious metals and find storage options for decades. They've also helped thousands of investors with their precious metals IRAs. Call today for your free portfolio review at 800-525-9556 or download your free report online by clicking the link in the video description to learn how you can double your gold and silver ounces even within an IRA.
Welcome back to Golden Rule Radio. This week, we have gold at around 1780, and here after the FOMC meeting today, it went up about $5, but overall from the week last week, it's about flat. Silver holding well above $26 an ounce. Platinum has been strong since last week, and also palladium has been strong since last week, breaking above 3,000 today, just barely. So let's start with gold, because I think there's a lot of questions out there about, are we going to see gold break 1,800? If we were to break above 1,800, that would be a trigger that would say that, yes, we're resuming the bullish trend, the long-term bullish trend. So really close to 1,800. I think I would want to see it get confidently above 1,800 for that. Or are we going to see a pullback? That is the question out there, I believe. Metals have been kind of flat for the last week, and we're really wanting to know which way it turns, because we want entry points, and if it moves a little higher and it gets above 1,800, we want to be in.
Yeah, speaking of entry points, Robert, I don't know how long we talked about the 1678 entry point going back to the beginning of the year, but if you look at this short-term market move, just to reiterate, gold's previous rise topped out at around 1960. Now that's obviously a couple $100 below where the ultimate all-time high hit last year, but this was in that medium-term, multi-month downward trend. So we started this downward move at the beginning of 2021. We came all the way down to 1678. We talked that number to death for about 2 months. Had a very beautiful double bottom there, and it has since turned up. And the one thing I do like over the last week or so is we've bounced above the 382 fib, which would be the first retracement level on the way back up, really the first place you can firmly put your foot down on the stair step climbing back up. And we double bottomed there this week in a very, very short term, just in the last couple days. So yes, gold pushing up to just under 1,800, bounced again this morning, as you mentioned, following the FOMC meeting, and probably will continue up from here. So lo and behold, the eternal entry point bearish market guy may just be about ready to say bull market. I said possibly last week. I'm going to say probably this week. So maybe in the next week or two, I'll get to say definitely. But we are looking at 3 higher highs and a number of higher lows, because even though we had a double bottom back in March down at 1678, the second touch was slightly higher than the first, and then we've had higher lows from there on up. So it does look like gold could be starting to stair step up. Now there are some bigger prices it needs to get above. Obviously double zeros don't mean anything except for it being a psychological number. But the number I'm more interested in is around 1875, because that's kind of your top shelf going back to early to mid-January. So 1875, 1880 is the number I'm really going to be looking for. And then obviously getting above the previous highs like 1960 and ultimately up and into the 2100 range.
Yeah, just to have it close above that $1,800 psychological number you talked about would be encouraging. But what you're saying is it doesn't mean a whole lot. We need to see the 1870. Are there numbers like that on the silver side, or are you expecting the ratio to stay the same and silver move sort of proportionately?
Well, at this point, silver's never really turned bearish. It's just continued to bounce uphill, certainly since April of last year. So not necessarily. I'd just like to see silver continue to climb, and the only number I really care about is getting above 30. We've done it twice now. I'd like to see us do it a third time, and then maybe stay above 30 this time instead of taking another drop. But a third touch into 30, the first one brought us down to like 22.5. Second one here just ended back in March, and that was about 24. It's very likely the next time we hit 30, it'll probably just blow right through. So that's the only real number on silver I'm looking forward to. I can't imagine anything on the downside unless something dramatic happens with the dollar. And having Robert back in the studio this week, we'll talk about the dollar here in a minute, which doesn't look too happy these days.
Yeah, we did talk about that in your absence a little bit last week, Robert. I mean, is this drop below 90? I mean, at least we're still above 91, so not below 90, but below 91. We talked about that last week, having come down below 92 to the 91.1, and now here we are, high 90s on the U.S. dollar index, and that decline continues. what numbers are key for you from a technical analysis standpoint on the U.S. dollar index?
Well, the key line in the sand that's been there is 89 range, which is that level that has been defended a number of times over the past 5-10 years. And so that's the key breakdown level. But since reaching 93, it's just been sliding right down here to 90.5. And so it's getting close back down to that 89, 90 level. And whether we see another bounce or not, it's really a question, I think, of how do you measure the dollar? Because we have this DXY, we have this dollar index that's mostly weighted against the euro, as well as a handful of other currencies. The weight being the euro 57.6, Japanese yen 13, pound sterling 11, almost 12, Canadian dollar 9%, Swedish kroner at 4, Swiss franc below 4. So what's the problem with measuring the dollar against those other currencies? Anybody?
Well, as they get weaker, it's hard to measure relative purchasing power.
It's relative. I think that's the key point. And, the relative inflation rate of those other currencies. And with the dollar index, you're measuring against these other currencies. And maybe a more accurate way of looking at the dollar in measuring its strength or weakness might be measuring it against a basket of commodities instead of currencies. And if you look at some of the commodities indices, you have, let's say, take the Bloomberg Commodities Index, it's been rising. And it's coming up to a level where it's about to break out above a pretty key level. And if it does that, then you're looking at a weaker dollar. Does that influence the DXY, the dollar index, relative to a basket of currencies? And does it slide there? It's a difficult question to answer. How do you measure the strength of the dollar? And then you could measure it in the price of gold. And the price of gold, I think, is going to be a good reflection going forward with gold rising because the dollar is going to be inflated. Tonight, here on Wednesday night, we're going to learn how many trillions of dollars are going to be created. I'd guess that it's going to be historic, right?
Well, they're talking 1.8 trillion just on this piece, right? So
it's trillion, okay?
Wait, so I have to interrupt here real quick. Just real quick. So are you suggesting something out of left field, like we actually take the value of the currency and we compare it to things we actually spend that currency on?
I know that's a hard concept to understand.
Like what's a commodity? Like food would be a commodity, so they definitely count food when they're talking about money, like spending and money
Obviously,
supply,
there's some
right?
sarcasm
Food.
in the
there's
question.
some deep sarcasm going on.
And oil, do they count oil? Housing expenses,
I think
clothing?
our listeners understand where you're
Mortgage,
where you're going
rent.
with this question, and it is such a good question because you look at the bills that you pay, the grocery bill, blah blah blah, and it's not just 2%. Obviously, gasoline, same thing here. It's up more than 2% a year in the last year.
Pick a commodity. It's more like 102% right now.
That's right. So the question of how much money is being printed, where does that show up? What's going to be influenced by that? And we'd argue that gold is ultimately going to catch a huge move higher with the money that's being printed and announcement being tonight and ongoing. This administration is trying to change the face of America, period. And they're going to do it with printing a bunch of money and influencing different markets.
And different demographics.
To different demographics.
Right? I mean, that's a key piece right here because they are targeting the spending. You got free preschool, you've got free community college, and those are things that aren't ever going to be pulled back away. It's like Social Security, right? Or welfare, or anything else that you end up promising to the populace that are irrevocable. Those are gifts that can't be pulled back. And so that's just the first piece. That's a targeted gifting, a targeted money printing, and all on the backs of increased taxes are going to be what pays for it, which means you really should talk to us about your traditional IRA and whether or not to be converting to a Roth or something else with your precious metals. But that aside, that's just step one. He's also talking about a $2.3 trillion infrastructure package. So that's what he's touting. And whether that gets mentioned tonight or not, I don't know. But between the two, you're over $4 trillion more dollars. And yet Chairman Powell today says inflation's just not an ongoing concern yet. And Robert, you're exactly right. To say it's at 2% is laughable. And we know with what we can buy, we know that it's more than that. And yet the Federal Reserve will not change their easing. They won't change their securities buying. They will not change the interest rate manipulation until they see stronger labor markets, from an unemployment number standpoint and also higher inflation. So Powell today says what? With regards to inflation, he says one-time price movements are not indicative of persistent inflation. So the good news is we have for everybody, Robert's point on the commodities breaking out, this is just a one-time move and it's not going to persist.
So what's the time frame involved between one-time moves so that they stay one-time moves? Like if it happens every day, it's inflation. What about once a week? Is that a one-time move?
How about a 6-month trend?
No, it's just the duration of time between when they state that it occurred makes it a one-time move. I feel like the trick here is you just have to take a word that has a very specific definition and then over a period of time change the definition of that word.
It's the name of the game.
We've seen them redefine what the definition of inflation is. We've seen them redefine what the definition of money supply is. We've seen them redefine what the definition of consumer price index is. And we've seen them redefine what the definition of their mandate is at the Federal Reserve Bank. So if you just change things on a long enough timeline so that you can keep telling the same story with redefined words, you're never technically a liar.
Oh, that's right.
Powell answered the question of the markets bubbling and getting frothy, saying that, it's because of the vaccines and everybody's excited about the economy, instead of, our monetary policy is actually driving it into bubble territory. Oh, no, it can't be that, right? No. So, it's a good thing that they only showed him from the neck up because, his pants are on fire.
That's a great point. The vaccination and the reopening of the economy.
That is not all that's driving the market higher here, obviously. And everybody in the market knows that. So why even hide the monetary policy effect in the market? Why? What's the point of that? Just lying.
I think they're still afraid of a turnaround in the economy. They would rather it keep going, right? It's the whole inflation being a runaway horse versus deflation being a dead horse. David McAlvany has said that multiple times on the weekly commentary. You can't revive a dead horse, but you can ultimately rein in a runaway horse. And I think that that's the hope, is they would rather see it overshoot, and they've got no intentions of changing here. He's saying inflation's not moving up in a persistent way because the labor market is not very strong. Well, it is very strong. I'll tell you why it's strong. Wages are climbing. He claims they aren't, but there aren't the number of people returning to work because they don't want to be returning to work. With all of the easing and the easy money, there are people that have found it easier to not be working than to be working. So until that alternative becomes far less attractive, you may not see true wage growth. But when you get wage growth on top of consumer price index spiking and true cost of goods running up, yes, that is where things catch on fire. And are we seeing that right now? No, but he has zero intention of reining it in before you actually see the proof. So he says, with regard to interest rates, we continue to expect it will be appropriate to maintain the current 0 to 0.25% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment. Whose? To your point, Miles, the committee's assessment of maximum employment and inflation has risen to 2% and is on track to moderately exceed 2% for some time. It's already exceeded 2%. We talked about it last week, 2.7, but it's just not persistent enough, guys. And so here we go. They expect to maintain an accommodative stance to monetary policy until these employment and inflation outcomes are achieved. We just talked about $4 trillion more going into the system. That's going to come. We talked about the fact that they're not going to slow down their accommodative stance. We talked about the fact that monetary policy and interest rate policy are not changing. And on top of all that, you haven't even seen the labor markets really take off yet and wage growth. How are you not moving cash to gold?
And in an inflationary system, when have you ever seen wage growth keep up with CPI? That's the other problem too.
Yeah, that's the decimation of the middle class.
Right. Despite wage growth, it's never going to keep up with the fact that at least around here, gas prices are up 35-40%.
Look at home prices. They want to manipulate the interest rates. That's driving lending. Autos, homes, anything that you have to borrow to buy. They want that to remain the case. Borrow, 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 go into debt, just like the government's doing. And there you go. Now you're past the point of no return.
What does that all mean? You pass the point of no return. I think this is an absolutely perfect setup for gold. with these fundamentals in play, the monetary policy that obviously they're not changing, the increase in debt from the government, the trillions of dollars of new money that wants to come on. Oh, does it also help that we've probably just from 2013 to 2019, we built probably the largest base in the chart of gold ever since the early 70s? Literally, the longest sideways movement for 5 years. Have we had another sideways movement and then a breakout like what we've seen in the gold price since the early 1970s? I don't think so. For 5 years, we built a base with gold directly across the board, no trend, sideways until mid-2019. We've broken out. Gold's ready to run higher. And then we've got all these other things in play. It is a perfect setup for gold.
That's going to do it for the special FOMC edition of Golden Rule Radio. As Robert was saying, the best thing you can do in these inflationary times is sit down with one of the precious metals advisors here at McIlvaney ICA and discuss your personal precious metals portfolio, as well as tax advantage strategies through things like precious metals IRAs. If you'd like to discuss your personal portfolio with one of us, you can give us a buzz anytime at 1-800-525-9556. You can find more info on our website at McIlvaney.com, Twitter at ICA Gold, or Facebook at McIlvaney Financial. Thanks for listening. Have a great week.